What role does a high-flying stock market play in deciding what the Fed might do at their upcoming meetings? Let's ask Richard Fisher. He's a senior advisor now for Jefferies. He's the former Dallas Fed president, also a CNBC contributor. And it's nice to see you. Welcome back.
Thank you, Scott. What's up?
You know, I thought that was notable yesterday in the minutes, where they said some note financial conditions suggest policy may not be particularly restrictive. And how they might look at this record run in the stock market amid calls that it's going to go even higher, and think about what their own policy decisions could do in fueling that.
Well, the head of the New York Fed, which is the most important person among the Federal Reserve Bank presidents, John Williams, made a comment on this yesterday, that he didn't feel that markets were necessarily being restricted. And, of course, the question is, how much has AI, which you just had a long discussion about, been fueling this market? But you should know that, again, the Federal Reserve doesn't really look at the equity markets. They look at the credit markets. And the credit markets are still pretty wide open. We haven't seen a real backup in spreads or yields. And I think that's really what he was referring to predominantly, not just the equity markets. And equity markets come and go. They've been on this, as you point out, we've had a 3-year rally here that's significant, in fact, incredibly impressive. I must say, though, for all those that are critical of the Fed, and if you believe the Atlanta Fed number now, 3.8% growth in a quarter, and the stock market an all-time high, kind of hard to criticize the Fed here for not having run monetary policy that is to the liking of the securities markets. And again, spreads are still low. Remember that, Scott.
The great debate in the room, so to speak, seems to be, and I kind of reference it, about how restrictive we are or we're not. Obviously, Steve Myron thinks that you're way too restrictive. Others are not so sure. And there's like a battle in the room over that idea. And it is central, of course, in how it's going to guide policy decisions going forward. What do you think?
Well, look, if you really look at the minutes with a keen eye, you'll see it's roughly divided 50-50 in terms of those that might want to continue to ease, that is, cut rates a little bit further, and those that are, I think, 10 indicated out of the 19 total. Now, Mr. Myron has an interesting view. He has to convince the other 18 people at the table of his view, and thus far, they don't seem to be going along with it. But I think it's good for him to present a counter argument, and we'll just have to see how others cotton to that argument. Nobody else forecast 5 cuts going forward, as Myron did. But to be fair to Steve Myron, he's presenting an intellectual alternative, and that'll be carefully listened to, and his job will have to be to convince the 18 others to go along with him. Not an easy task. So I do think it's evenly divided, Scott, and we'll just have to see what obtains here. If you listen to John Williams, you get a sense that they might be leaning towards 2 more cuts this year. We'll see, another quarter perhaps. If you listen to Governor Barr, who just spoke, it doesn't seem to be going that way. So we'll just have to watch this carefully. Right now, the economy is obviously, we know, struggling on the employment issue, even though that we don't have the official data coming out. And there is skepticism going forward in terms of inflationary expectations that getting down to the 2% target is going to be very difficult. And in fact, we might have an inflationary bump as people work off inventory that they accumulated in anticipation of the tariffs.